All right, happy Friday, everyone. Today I'm going to be going over a systematic strategy I've used with quite a bit of success over the last few years. It's not an original idea that I had. It's one of the first strategies that I ever learned that I tested and found to be successful, and I've used it ever since. In my previous video, I said I was going to be going over some discretionary strategies potentially, or a discretionary strategy that I've been using, and I'm referring to this one. It's not really a discretionary strategy, although you can layer on discretionary aspects to make it more viable. As such, considering this is a quant related channel, I should be admonished for saying that I was going to be doing discretionary content, and even so, I'm still going to show what I've used in the past. So the setup here is pretty simple. It basically revolves around having four different moving averages. You have a 200 SMA, a 200 EMA, an 8 EMA, and a 21 EMA. And there's just some different color codings on this. If you want to get the strategy yourself, you can type in something like this into GPT, and it'll give you the strategy without any issues. I've tested that out myself. At some point, I might just publish this. It's a pretty simple indicator to build. But it's just, you can also just put it together yourself using any multitude of MA indicators that exist for free on TradingView. I prefer having the colors, and that's when I first saw it. I was shared the strategy with the colors, and it just helps draw your eye to where the key points of interest are. So the basis of the strategy is to use the 200 EMA and SMA as macro trend determinants, and then the 8 and 21 as lower time frame determinants. Generally, when you're above the 200 EMA and 200 SMA, you're in a bullish trend, and you can look for anything as taking a long. And when you're below that, you would look at anything as taking a short. That doesn't mean you can't counter trade the trend. You certainly can do that, and if you test this yourself, you'll see that quite often, if it falls below the 200 EMA or SMA, it'll mean revert back to the 200 EMA and or SMA, and you can use those to counter trade if you'd like to do those kind of things. So if I zoom out, you can see how the colors kind of help here. So if the basis is to start with the 200 EMA and SMA. And there's two components to this. The first component is the color, and so the color is just dictated by the slope. So the slope, when the slope is up, it's going to be green. When the slope is down, it's going to be red. And i.e., when it's down, it's going to be in a downtrend. When it's up, it's going to be in an uptrend. The other component of that is the cross. So when the 200 SMA is above the 200 EMA, remember that the EMA, if you're familiar with EMAs and SMAs, you'll know that the EMA tends to respond a little bit quickly because it's the more recent price action is more heavily weighted than a standard SMA, which is just a linear weighting. You'll see when the trend really kicks off is usually after a cross. And so mathematically, this just works out such that the 200, when you're moving from a bearish trend into a bullish trend, the 200 SMA is generally going to be below the 200 EMA, and then they will generally slope up. And so you'll see here, as they slope up, you'll see this darker green color is going to be the 200 SMA, and the lighter green color is the 200 EMA. And so as they start to slope up and cross, you'll notice the cross actually happened farther back in history. I'll have to use a different point because there's not 200 points back there. Here's another one. So you have the 200 SMA. When the 200 EMA crosses over the 200 SMA, the trend really starts to go. So that just means that it's accelerating faster as those later points in time are gaining a heavier weight. And so the EMA is just naturally going to overtake the SMA. And so this is the most bullish macro posturing when you're in a macro trend. And so what you can expect oftentimes in those trending moves is a reversion to the mean, right? And what I mean by that is that eventually the price will come back and touch the 200 EMA or SMA, and then that, depending on the time frames you're trading. That could be an opportunity to buy more or buy the dip, or that would be the time when you would want to be cautious for macro trend change and when you'd want to get out of your positions. So using that as the macro trend, the next piece that you would look at would be the 8 EMA and the 21 EMA. And so the concept is the exact same. We have a light green for the EMA, we have a darker green for the SMA when they're both sloped up. And you have the same concept here, which the idea is when excuse me, I misspoke. These actually turn colors on the cross, not the slope. And so when you have the EMA crossing, the 8 EMA crossing the 21 EMA, that's when the colors will change. And so that's your lower time frame lower time frame signals to enter a trade. And I'm only talking about long trades. You can flip this in reverse to go short as well. I've seen people use this strategy to do similar, to also do mean reversion plays. So for example, here would be an example of when the 8 crosses over the 21, the lower time frame trend has now changed towards down, and so you might be expecting a play all the way down to the 200. Sometimes these will get front run. It depends on the time frame you're playing. You'll see multiple times these are kind of front run. Oftentimes when the trends are changing, you'll see the trend will take off, and as the trend takes off, it will come back and touch. This is that touch, as I was mentioning, that might be a time for you to get out or to add to your positions. If you've been in a macro downtrend and you are looking to go long, or based on time, you're now expecting the trend to start turning up, that touch of the 200 EMA or SMA would be a good time to add to your positions if you haven't already started building positions. It might be the case that you start building your positions in a lower time frame when you're, as I was mentioning, when you're under the 200 EMA and SMA and expecting a retouch of the 200s to add to your position as you're building your position as the market continues to mature and increase. So this would be, I'm definitely cherry picking here, so you should test this yourself. But I'm just using these as an example to explain the strategy. So here you might have decided to enter once this 821 EMA cross occurred, expecting a play up to the 200s. You got your play up to the 200s. Maybe you want to lighten your load at the SMA and then lighten it a little bit more at the EMA. If you're going expecting a much longer play, maybe you just continue to hold your positions, but you'll see that you broke out and then you had basically a retouch. It didn't get all the way down there, but it did get close to the 200 EMA. And that might be where you want to continue to add to your positions. And then the trend continues on, and you'll see that trend continues on above the 200s for quite a period of time. You do get some touches here and there. But if you're using your 8 and 21 EMAs, you could choose to exit your position just based off of that. Okay, so now that I explained the strategy, let's get back into some more quant-related things and statistical analysis here. So this is one of the very first strategies I've ever built. I built it multiple years ago. Probably been 4 or 5 years now. And so I'm just going to turn this on. This one strategy, all it is doing right now is it's strictly testing going long when the 8 and 21 EMA cross. And then do I have shorts turned on? I don't have shorts turned on here. And so obviously these are kind of ridiculous percentages. This is trading on a percentage based, and so it's not really realistic to what you would expect. But what is realistic here is that you can see that you get a pretty decent profit factor. There's not a lot of trades that occur here. And so I've been watching this a long time myself. I tested it manually. I tested it on multiple time frames. I tested it with different assets. It was the very first strategy that I validated and saw success with. And as a result, I just continued to use this strategy for quite a long time. without trading more in a systematic way. As I mentioned, you can layer on more things here. And one of some of the additional pieces that I've used in the past are over here. I won't get into these. Basically, there's some different stochastics and MACD and using bullish and bearish divergence. I mean, these are pretty basic trading concepts, but I just wanted to share the strategy. When I continue to do market updates, when I do my market updates, this is generally what I'm going to be looking at. I like to have the colors here, as I mentioned. This is just makes it super easy to just kind of glance at where the macro trends are. Let me turn that strategy off because that's a bit noisy. I prefer to not have all that on there when I'm looking at this. And so, yeah. If you so, as I mentioned, I'm going to continue to use this when I do further market updates. And if you're interested in that or you have any questions, feel free to post a comment down below. And enjoy your Friday.